Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of why the Modigliani-Miller Theorem matters in modern finance. Dividends and stock value. Another important implication of the Modigliani-Miller Theorem relates to dividends and stock value. It suggests that the way a firm distributes profits, through dividends or stock buybacks, does not affect the stock's worth in a perfect market. Consider these insights. Dividend policy doesn't matter. Firms can set their dividend policies without concern for how it will sway their stock price. This indicates that investors should focus more on the company's overall performance than on regular dividend payouts. Investors create their own cash flow. If companies don't pay dividends, investors can sell shares to generate cash, replicating the cash flow they would receive otherwise. This gives investors the power to decide how much cash to take from their investments. Market perception. Even though companies might feel pressured to pay dividends to attract investors, the theorem implies that doing so is unnecessary for maintaining stock value. Visualize a public park where families can enjoy their time. Some families prefer picnics, dividends, while others might want to go for ice cream, selling shares. The experience remains enjoyable regardless of how families prefer to use their time, just like the firm's value remains constant. By grasping these implications, investors can make better financial decisions rather than relying solely on conventional wisdom. Understanding that the capital structure and dividend policies don't affect firm value shifts attention toward a company's operational success and strategic growth. Critiques and limitations. The Modigliani-Miller Theorem is influential, but it's not without flaws. Critics point out several gaps and real-world complexities that can challenge its core ideas. Let's explore these critiques, focusing on how real-life factors and alternative theories push against its assumptions. Real-world complexities. While the theorem operates on neat assumptions, real life is messier. A few key complexities that the theorem overlooks are: information asymmetry. In the real world, not everyone has the same information. Companies often possess private data that investors don't have. This can lead to biased valuations and financing options. Market frictions. Transaction costs, taxes, and regulations can impact financing decisions. These frictions can lead companies to lean toward one financing method over another, contrary to the theorem's claims. Bankruptcy risk. Real companies face bankruptcy costs that can significantly impact their value. This reality affects how firms think about debt. They can't ignore the risks associated with taking on too much leverage. Investor behavior. Investors don't always behave rationally. Fear, greed, and market sentiment can affect valuations and decisions in ways the theorem doesn't account for. By ignoring these factors, the theorem simplifies a complex financial landscape. It presents a model that can be hard to apply practically. Alternative theories. Other theories provide different views on the relationship between capital structure and firm value. Some notable ones include trade-off theory. This theory suggests firms balance the tax benefits of debt against potential bankruptcy costs. It recognizes that while debt can be advantageous, excessive use can harm a company. Pecking order theory. According to this perspective, companies prefer internal financing, retained earnings, first, then debt, and finally equity. This theory highlights that firms have preferences for financing sources based on cost and market conditions. Agency theory. This theory focuses on conflicts between management and shareholders. It asserts that financing decisions can influence these conflicts, as managers may prioritize personal interests over shareholder value. Exploring these alternative theories enriches our understanding of capital structure. They address the limitations of the Modigliani-Miller Theorem, particularly by incorporating aspects of risk and behavior that the theorem tends to overlook. By examining these critiques and alternatives, it's clear that while the Modigliani-Miller Theorem provides valuable insights, it does not cater to the complete picture of finance and firm value. Understanding these limitations is essential for investors and practitioners navigating real-world complexities. Applications in modern finance. The Modigliani-Miller Theorem remains relevant in today's financial practices. Understanding its application provides insights into corporate valuation and investment decisions. Corporate valuation. The Modigliani-Miller Theorem plays a significant role in corporate valuation methods. When assessing a company's value, it emphasizes that capital structure should not influence that assessment. Here's how the theorem is applied in practice. Valuation models. Analysts often use discounted cash flow, DCF, models. In DCF, future cash flows are estimated without factoring in whether they come from debt or equity. The total enterprise value remains unaffected by the financing mix. Comparable company analysis. When comparing companies, analysts recognize that differences in capital structure do not determine value in a perfect market. They focus on operational performance rather than how each company finances itself. Market perceptions. Investors often look beyond financing choices. They seek companies with strong cash flows, effective management, and growth potential. The theorem reassures investors that capital structure is secondary to these fundamental aspects. By keeping the focus on operational performance, companies can attract investment based on their merits rather than financing strategies. Investment decisions. The Modigliani-Miller Theorem also influences investment decisions. Here's how it affects how investors and companies think when making choices. Project evaluation. Investors assess projects based on expected returns against risks. Financing methods are secondary. This encourages firms to pursue the best projects, regardless of how they plan to finance them. Risk assessment. Investors recognize that risk is not solely tied to capital structure. High levels of debt can signal financial risk, but the theorem suggests that firm value remains constant. This understanding helps investors balance their portfolios. Value creation. Companies focus on value creation through operational efficiency rather than playing around with financing options. This directs attention to innovation, customer satisfaction, and market expansion. In conclusion, the Modigliani-Miller Theorem informs how we think about value in finance. By understanding its applications in corporate valuation and investment decisions, stakeholders can make more informed choices. Conclusion. The Modigliani-Miller Theorem offers a compelling perspective on capital structure and firm valuation. It suggests that a company's worth remains constant regardless of whether it chooses debt or equity for financing. This foundational idea reshapes conventional finance thinking, but it isn't without its limitations. Key takeaways. Irrelevance of capital structure. The theorem asserts that how a company is financed does not alter its value in ideal market conditions. This means that, theoretically, managers can focus more on operational efficiency instead of financing choices. Assumptions matter. The theorem is built on assumptions like perfect markets and no taxes, which rarely exist in reality. These assumptions simplify complex financial decisions but may not be useful in the real world. Impacts on investment. Investors can use the theorem to evaluate projects based on expected returns rather than the specific financing methods used. This allows a focus on quality investments without the distraction of capital structure. Modern relevance. Even with its limitations, the theorem influences corporate valuation and investment strategies today. It serves as a critical baseline for understanding how companies can create value amidst varying financial methods. By grasping these points, investors and finance professionals can better navigate the complexities of capital structure in today's financial environment. The Modigliani-Miller Theorem invites us to reconsider traditional evaluation metrics while highlighting the importance of operational prowess in achieving financial success. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.